Hi, Chris. Good to see you again.
Hello, Lee. Good to be here. Another busy week.
And there's been some good results, hasn't there? We've got a few companies from the small cap market that are quite looking forward to sharing. Pretty good
Yeah,
numbers as
yeah,
well.
yeah, really good. And one of our bonkers bargains, amazing return from one of our bonkers bargains. I'm sure we'll have a brief mention of that later. But yeah, it's really good, as you say, some encouragement.
Yeah, it's good to see that in the UK share market. First, the income boosters holds Hargreaves Lansdown and Page Group, but these are going to be leaving very soon, aren't these? So, what you're looking at next?
Yeah, one sort of good news and one's not so good news. Our income boosters portfolio is focused on higher dividend paying stocks, large companies, typically some really big ones in there and of mid caps as well. But the focus is on elevated dividend income ahead of what you can get on the FTSE. Circa 6%, I think the dividend yield is on those. And we're looking up the scale as well because there's great value to be had in big dividend paying stocks in the UK. A lot of them have been unloved. A lot of them are a bit cyclical. We think the cycle's improving for them. But yeah, we've got two announcements. Hargreaves Lansdown, which we spoke about previously, has got this takeover approach. We got a 40% gain since we've held the stocks. That's been good. Unfortunately, we get the quick profit, but we've got to find an alternative dividend paying stock. And Hargreaves Lansdown was paying out handsomely for us. So we've got to probably wave goodbye to that one. Looks like it's going to go through that deal. Another company called Page Group, the recruitment company, less good. We're a bit puzzled on that. The outlook hasn't been great. It's been struggling, but bizarrely, it committed to increase its dividend, which isn't covered by cash flow, and its cash balance is depleting. Page says it's ahead of things improving, but we don't like that. We're a bit uncomfortable, so we've decided to get out of that one. We need to find some replacements. So good and bad in there. Page Group, we
Yeah.
haven't lost money on, I should add, in the period we've held it. We haven't lost money, and we've received a decent dividend. But our view is, now, when you see problems, you're uncertain, you're unsure, let's get out, move on. There's plenty of other opportunities out there.
What's the sort of parameters that you look for before adding a new company to the income boosters portfolio?
We're looking for dividends and dividend growth, sustainable dividend growth, and a business that's been a consistent pair of dividend income. It's UK listed, typically main market, FTSE 250. Market cap, we prefer, is around about £1 billion, slightly larger. We've got one or two just a little bit under that. That's our general cut-off. And we like to see evidence of growth as well. They may be going through tough times. We want to see that growth coming through. But most importantly, and just as we've had with Page Group, what we want to also see is dividend cover and by cash flow, not just dodgy adjusted earnings, but real cash flow, free cash flow cover of the dividend. We don't like to see businesses effectively paying dividends out of debt just to satisfy their shareholders, which you got the sense that Page Group has got some probably income focused shareholders. It's let's keep the dividend. They won't like it. We don't. They might drop our stock. And so they're paying beyond their means for the time being. We don't really like that. But there are loads of other opportunities out there, and we don't think we're short of ideas to add.
So basically, you're drawing up the shortlist now. They'll
Yeah,
be added in due course to the
absolutely.
portfolio.
There might be a few more changes. We're getting a bit more aggressive. We're trying to punch a bit higher on the yield because we can also see some decent growth and recovery opportunities in there as well.
Yeah, perfect. And I think we've mentioned this in the past, haven't we? People can access the portfolio just by scrolling down and signing up for the Investors Champion platform, can't they?
Yeah, absolutely. Yep.
The government has just announced that the new government, the new Labour government, has just announced that the British ISA is going to be scrapped. What's your thoughts on that? Because pros and cons, hasn't it?
Yeah, I think we spoke about it when it was announced a few months ago. And yeah, it was a bit of a trifle, but yeah, every little helps kind of thing. They've concluded it's really just overcomplicated and why bother? There's 20,000 quid ISA allowance or anyway. And interestingly, some investment sites, some of the big investment sites have welcomed it, and they're in a pretty good position to understand the situation better than many of us. So yeah, it's out. And I do think it was a bit of a trifle. And it's already pretty complicated, our tax planning regime, our tax regime as a whole. And it probably wasn't going to move the needle very much. So why complicate the situation?
Yeah, fair comment. As we're on tax changes as well, the HMRC's just allowed fractional shares to be added to ISAs as well, which is positive for those perhaps with less resources, isn't it?
Yeah, it is. It is good for that perspective, and it encourages interest in individual companies, which I think is really great. The problem is certain shares, the single price per share can be very high. At the extreme end of the scale, you've got US listed Berkshire Hathaway, Warren Buffett's company. One share will cost you $708,000, one A share. Even the B shares go for $470 a piece. So you can imagine if you're a small investor trying to build a portfolio with which includes Berkshire, that you're going to struggle. And, in our ultimate stocks portfolio of high quality growth companies, for example, Games Workshop shares are over £100 a piece, and Booking.com, which we like, nice, the online travel agent, they're at $3,700 a piece. So you need quite a lot of money to simply buy one share or a balanced portfolio. So this is a good idea, I think, and it will encourage investment. Saying that, on the negative, being realistic, and this won't necessarily go down that well with all the listeners, a lot of small investors should really be buying collectives to get that. And there are some passive investment index funds, even specialist funds following niche indices that can be bought for very low prices. So if you want a nice broad-based exposure to the stock market and you're starting up, just buy a fund, we would suggest, is a better route. But if you're really interested in individual shares, yeah, this is good news. Good news. And we'd like to encourage that as well.
Moving on to more company specific, and unfortunately, we've got expression of interest for Rightmove, haven't we? Which is a fantastic company. And the expression of interest has come from Rupert Murdoch's News Corp. I can already guess what your thoughts are, but it's a potentially another UK success story being taken over by a larger international competitor and a UK tech success story as well.
It's an interesting one, isn't it? A Rightmove's quite an unbelievable business. Everybody worries how its position might be threatened, but that hasn't seemed to be the case. It's the type of company that everybody, if you're an investor and you want to look at an amazing business that dominates its market, it's got eye-watering margins, it's got 80% share of the UK market, and investment attributes, operating margins of 70% plus, return on equity is 300%. It buys back its shares all the time. Massive cash generation. So it's a really great business that's been developed here. And yeah, this company, an Australian group that's backed by Rupert Murdoch's News Corp, is looking to take in an interest in it. Watch this space. But it'll be sad to see it leave because it's a type of company that the UK stock market needs.
Yeah, it's just another one in a long list, isn't it, of companies that seem to be being picked off.
Yeah.
I wonder why Rightmove wasn't particularly looking at the opposite, perhaps.
Yeah, it's a really good point because when you look at the history of this REA group, it's listed on the Australian stock market and it's a lot bigger than Rightmove, and it's been far more aggressive, and its market capitalization is about $17.6 billion US dollars, about 26 billion Aussie dollars. So that's several times the size of Rightmove of circa £5.5 million. But yeah, REA's been very aggressive in its growth. You're right. Could Rightmove have adopted a similar sort of expansionist policy and developed faster and grown bigger than it has done? This business REA was absolutely smashed to pieces a few years ago. It's when News Corp bought into it, it was worth peanuts, virtually nothing. It was going back on the edge of going bust. And look how it's risen, clearly with the right management team and the right support. Yeah, and is there evidence of this lack of ambition across the UK market? Are we too inward thinking rather than outward? Some companies are very good. I can name Fever Tree Drinks, which is making a real push into the US, very ambitious from a very stable UK base. Hey, that's Fever Tree's on AIM. I should add that's a company we hold in our fundamental AIM portfolio. But yeah, could some other UK companies be a bit more ambitious? I don't know. A bit frustrating, especially to lose one like Rightmove.
You on Rightmove in either of the
We don't.
portfolios?
No, we don't. I think the price looks up with events now, probably, in our opinion. It's a lovely business. One of those things that you look at it's one of those companies you look at all the time. You think, oh, great business, but expensive. Great business, and the shares
Just keep going.
The shares actually haven't been gone very far lately, but previously, a few years ago when you looked at it, and they just keep going. You think, oh, crikey, I've missed the boat. I've missed the boat. But yeah.
The one that got away.
Yeah, absolutely. Thankfully, there are some that we got, but others the one that got away.
Yeah. Should we move on to the small cap news now?
Yeah, some excitement in there.
Yes, there is. Yeah, I've been looking forward to chatting through these with you. Filtronic has got another order from SpaceX. Fantastic news.
Yeah, it's brilliant. This little business has been chugging along for a while, and suddenly it's got these deal, and SpaceX is going to take a stake in it as well as a
Wow.
result of all these
Yeah.
contracts. And it produces products for the aerospace, defense, telecom markets, and it's supporting a SpaceX Starlink constellation program, which is great news for Filtronic. And yeah, long may it continue. Hopefully, it can't go far wrong with a partner like SpaceX, even if it's had to give away some shares to get in that position. It can only be good. SpaceX interests are very nicely aligned with Filtronic. So yeah, good luck to it, and maybe we'll see some more orders coming as well.
What's the long-term projections for the business? What could this business potentially grow into?
The housebroken Cavendish at Filtronics put out a note, and they've identified in this low Earth orbit satellite communications market that there's an addressable market for Filtronic in the range of 100 to 300 million. When this business is only picking up contracts of 1.5, 2, 3, 6, whatever, 10, you can see there's a long way to go, long way to go. So yeah, it's
Does
seemingly there's a big opportunity for it. And this is, remember, only one part of its business. Clearly this part is doing very nicely at the time for the time being. But yeah, it's got other segments that it can also address.
definitely worth a look at then,
Yeah.
isn't it?
Yeah, it is.
What about Ashtead Technology as well? Another company that's had really good results, but the share price went the opposite way.
Yeah, it's a bit of an odd one. Ashtead Technology had been on the market since 2021, I think it listed. It's been an amazing performer since it listed on AIM. AIM's listings have had a lot of bad press, especially in 2021. You had a lot of listings, a lot of them have failed already. But Ashtead came in November 2021 at £1.62. The shares hit a high of £8.93 in May. They're back at around £6.90 now. Got fantastic results. It's a business that rents equipment to the subsea market, offshore market, and it's supporting both the oil and gas and also the offshore, the renewable side. So yeah, it's in an exciting space. Revenue's growing strongly. Offshore renewables bit of it as well, which is good because it's not just all about oil and gas. The renewables bit grew about 42% revenue, 20 to 23 million. It's now 29% of the total. So that's pretty good. That's been going up and up. Soon hopefully could be close to half of the total revenue. But yeah, despite these great results and profit climbing 33%, not all of it was organic. Some of it was driven by acquisitions, but that's the nature of the game with this. It's some of organic and some acquisition driven, all out of internally generated cash flow. And its rental fleet, its fleet of rental component has risen. And despite that, all the good news, the shares have fallen back. And people are maybe a little bit wary of the cyclicality risk. Everything in oil and gas, they're always worried about the cycle. And clearly, you've had that down, you've had this up now. So oil prices being supportive. The renewables piece, I think, changes it off for this one. That's growing, so that's taking up some of the slack, and they're going to need more and more maintenance. This isn't a capital play. This is generally a maintenance play, which is
Yeah.
good. So it should be more repeatable and reliable. But yeah, the rating, look, shares trade at what, about 18 times forecast earnings, I think, which doesn't look bad to us based on the growth, which is a little bit less than that projected growth. But yeah, it looks a nice play. Again, we mentioned this is a business we looked at. We're always a bit reluctant for new listings. The shares started flying. It looks a bit pricey at one point. You think you missed the boat. There you go. Now they've fallen back quite a lot. There could be a buying opportunity for people in this one. And we're looking at it for that reason as well.
Nice little company there to think
Yeah,
about
it
then,
is.
isn't
Yeah,
it?
a good positive listing, positive for AIM, London's junior stock market. Hey, you can make a lot of money if you pick the right ones. This is an example of it. And
Yeah.
boy, come on, this is not the most exciting business, is rental equipment. But so you can make there's money to be made in any sort of investment, even renting boring old equipment.
Yeah. Good pitch there for the market there, Chris.
Yeah,
You're good.
I do my best. I do my best.
Yeah, moving on to the next company that is really interesting as well and worth champion, Craneware, a company that Fundamental is invested in as well.
Yeah, it's a provider of software to the US healthcare sector, particularly hospitals. And we, Fundamental, have had a stake in Craneware for a long time. And it's got 12,000 US hospitals as customers, and 12,000 hospitals, health systems, pharmacies, and clinics. So look, it's got an amazing presence. UK company that only supports the US market. But I won't go over the numbers. The results are pretty good. The valuation is quite rich. It's quite very highly rated. It's still investing a lot in its technology. It's moving a lot of stuff to the cloud. This value cycle attention is really a focus for US healthcare, proving the value of interventions. However, what I think is really interesting about Craneware, which could be the future, There's this 200 million patient encounters. It's got this partnership now with Microsoft as well, which could unlock some serious data crunching, I would have thought, in its 200 million patient encounters. When you can think you can start analyzing this with AI, what could that reveal? How could that support improvements in health? They've also been moving stuff onto their cloud base. But yeah, they seem to be on track now. They made a big acquisition, debt's fallen, cash flows very strong. Part of their model is they collect cash for their underlying customers that read through them. So cash flows are very strong. But yeah, I think it's just very interesting. And this Microsoft partnership they've got, so Microsoft will effectively be selling their or promoting their products as well, and vice versa, is only healthy. But that data set, I think, is a really interesting, has interesting potential.
What was it that drew you to them originally 8 years ago to be able to get in
Even
early?
before then, I can't. It wasn't even early. They've been around for a while. It's one of those businesses that listed. It was already profitable very quickly. Interesting position, great margins, fabulous growth. It was growing very fast, and that suddenly slowed down. And its rating was quite full. It's founder led still. Keith Nelson, the founder, is still running the show. He's got a decent equity stake in it, so good alignment. It ticks a lot of the boxes for us. We love software companies with great visibility. This business has got fabulous visibility. You know, you can see a year out what it's going to be earning, which we like to see. Fantastic cash flow as well, which is good news. Ticks a lot of boxes, good margins. As I say, it hasn't all been smooth though, and people will look at it and say perhaps it's not the business of it was 8 years ago because growth hasn't been quite as it was. But we think there could be another leg here now, and this bigger businesses looks quite encouraging. Its rating is more in line with on the US market, trading at what 29 times forecast earnings, so it's pretty pricey when you're only looking at single digit earnings growth, but it's highly profitable, and so it's not just about the top line.
There's two other companies as well that we've mentioned once or twice on here, isn't there? Two Bonkers bargains that you've been championing as well for quite a while.
Yeah, I have. And they're both in the construction materials sector in the UK. These were two of our bonkers bargains that we picked up. We think they look very good value. Clearly, the construction materials sector is in a horrible state in the UK. Interest rates are impacting house building. Nobody's been interested. But they're two very different stories. Alumasc is a creative premium, called itself sustainable buildings products. And the shares look just cracking value. When we first looked at them, I think they were yielding 6%. Single digit multiple. They tidied up the shop. They got rid of a loss making business as well. But the really exciting bit about Alumasc is it's some Timlock house building products business. Now, in all this downturn, when anything connected with house building has been going backwards, Alumasc has just announced results with its Timlock business actually grew. And I think that's remarkable when everybody else has been showing losses and negative. So well done to Alumasc. The shares still don't look expensive. And how well can this do? How well could it do, the Timlock business, when the market recovers? I'm excited to see. I want to hang around to see how that works out. So we think this is worth supporting. It's been around for a long time. It's got different divisions as well. Some in the sort of water management area, guttering and drains. But the Timlock bit has lovely margins. It's just one, probably I think the smallest of its three divisions. But yeah, worth keeping an eye on, little Alumasc. Another one is called Michelmersh Brick Holdings, which is a specialist brick manufacturer and brick fabricator. It's different. It's struggled. It's obviously directly facing US house building as opposed to general construction sector. Clearly, that's been tricky. Its half-year results showed a declining revenue, but this business has got a fabulous, rock-solid balance sheet, no debts, net cash position, nice dividend yield as well. It was buying back shares previously. So again, both of them are recovery plays on the UK house building sector. Michelmersh probably more. Alumasc is proving itself, whatever the weather, which is amazing. And both, I think, look really good value. So worth looking at. Don't take our word for it. Just have a look. I just think they look really compelling value, but for slightly different reasons.
Would you say that News Corp's expression of interest in Rightmove is a bit of a validation of the UK property market?
Good point. Good point. They know it's going to recover. Yeah, get in there before it does, because everything is going to be on a much higher rating. Hopefully, these two are going to be multiples of their current size in a few years' time. because they deserve to be. Michelmersh is still committed to investing in plants and upgrading stuff. And it's one of what, 4 remain. This is virtually closed shop now. Brick making in the UK is closed. There are basically 4 significant players, and Michelmersh is the smallest of them. All the other 3, one of them's German owned or Austrian owned. The other ones are the UK listed ones, Ibstock and Forterra. Basically, it's a closed market. There's no other consolidation opportunities in the UK. So get a piece of the market with Michelmersh.
How many Bonkers bargains does Investors Champion list?
I think we've got about 15 going at the moment, which we
Right,
think
okay.
look decent value, approximately. We issue regular updates on their news, so you'll see them come out, and some of them look more bargain-like than others. Some, like Alumasc, have performed terrifically, others less. We've had some strugglers. Unfortunately, when you're buying these value plays, some of them are value traps, and some of them you have to wait a long time so they come good. I mean, Alumasc has been pretty good for us, but we've got another one in particular. I won't mention it here. You'll have to read the notes. That has done really well. And it looked incredibly cheap and still looks incredibly cheap. And again, as things recover, it could do even better.
So there you go. There's 2 of the Bonkers bargains from a total of 15 on the Investors Champion website. So moving on now to a Jet2, a company that I think Fundamental has been invested in for quite a while. Although you did sell out, didn't you? You sold out and then you bought back in. And they've just released another update that was worth a mention.
We used to hold Jet2 a long time ago, sold out, a bit worried about things, then got back in across our fundamental portfolios a few years ago. We got a good bounce out of we got in more meaningfully around pandemic when the shares got cheap. We added a loss in there. So we've quite got a decent position. Clearly there was a bounce then, but since it's been flatlining a bit with concerns over the consumer downturn. It's AIM's largest company, Jet2, leisure travel group. We think it's got a really good proposition, liked by its traveling customers, ticks a lot of boxes. Founders still got a big stake. It hasn't committed to guidance, a bit reluctant to commit to full-year guidance, but it seems to be doing fine. Its fleet is growing, and it's filling its growing seats. It's just a point behind. It's enlarged seat base, as it were, the number of carrying passengers it can take. The main focus is on the package holiday. It's not just about the seats booked, but it's about combining those with a package holiday. And it's ahead of EasyJet. It's ahead of Ryanair, who's now looking to get into this space. And it was ahead of the game. And as I say, people seem to like what it does, which is at the end of the day, the most important thing. It's not just about profits, revenue. The customers like this business. That's surely the key guide as to whether the proposition is good. So yeah, it was a reassuring update.
I mean, that's 6 companies there, isn't it, that are all doing really well. 6 UK companies on AIM that are doing really well. We're taking a closer look at.
Yeah, and all very different businesses, aren't they? I mean, we've jumped around from specialty electronics to bricks to Jet2.
Hospital patient software.
Yeah. Which doesn't even, a UK listed company that has no UK customers. All its customers, Craneware, are US hospitals. It can be done. You went back to ambition. Clearly, Craneware, it must have had considerable ambition when it started up.
Yeah, that's true.
I mean, that was a leap of faith. Right, we can supply the US healthcare sector. Wow, from Scotland. Brilliant.
From Scotland, yeah, that's pretty sure.
I think that's great news.
Yeah, I mean, that's what this is about. There's 6 companies. Go and have a look at them. But we're going to finish off with Churchill China, which you were telling me a story at the beginning when you go out to the restaurants or for a bit of a pub lunch. So what do you do, Chris? You pick up the plates, pick up the cups and look underneath to see.
Always pick it up. Always pick it up. And if you do, it's likely in the UK and overseas that 50% of the time it's going to have Churchill China's stamp on the bottom. This business is a major supplier. It's a lovely little company, still a lot of family-related ownership in there, original family owners. It's a really nice business. It's a manufacturer of ceramic products for the hospitality sector. That's what it focuses on. And hospitality has pretty strong demands. It needs to have very robust ceramics, and Churchill specializes in that. Really strong stuff that doesn't break very easily. But if you go out, I like to lift up this thing and see. And clearly hasn't been that easy in hospitality for Churchill. Just announced its results. The revenue fell circa 8% to 40.6 million. But look, it still made pre-tax profit of 4.8, so over 10% margins, even when things aren't going very well. Geographically, it supplies stuff all across the world. UK held up well, along with the rest of the world. In the USA, Europe was a bit weaker. But yeah, it seems to be dependent on a stronger sort of final 4 months to meet expectations. But have a look. This is a nice little business. If the shares get cheap, they'll come back. Management are clearly confident they've upped the dividend despite profits being a bit flat. So they've upped the dividend 4.5%. You got a yield of about just shy of 4% on it. And it used to come on quite a high rating, so the ratings come back a bit. But look, it's never going to knock the lights out, this thing, but it's a pretty steady performer on AIM that's compounded over time quite nicely. As I say, you've had a rising dividend. It'd be interesting to see what this divvy was like a decade ago. So you've had decent dividend growth as well, and they're it looks very well managed. Decently invested in its business as well. Keeps up that investment, becoming more energy efficient. Clearly, energy costs when you're firing kilns are significant. Those are generally covered and hedged. So yeah, nice business. Another sign of the variety in the small cap world. It's supplying stuff all over the world. I was in Europe. I think I looked up and I saw it was a Churchill plate. And it becomes quite distinctive. You can start recognizing their stuff without even looking at the bottom.
You sat there having your lunch and then you're looking across the table. You just see this guy lifting up the bottom of his plate to examine the underside of it. And
I know. Happens,
and it's Chris.
happens.
It's Chris seeing who the manufacturer is.
Yeah.
A really good variety of that. Another great episode. Thanks, Chris.
Thanks very much.
Well, that's it for today. Please subscribe for next week's episode as we will once again discuss global events, the UK share market, and some more bonkers bargains for you to take a closer look at. If you want to take a deeper dive into any of these topics and indeed more exciting and interesting companies, then please feel free to visit investorschampion.com to learn more. All the links are just in the show notes just below. Many thanks for listening, and we hope you have a great day.